Thank you all for joining the Home Buyer Seminar for JMK Mortgages. I am Jamira Kendricks, and I'm going to give you some information today. Um, First, just a little bit about myself. I am a mortgage loan officer, or originator part-time. I am a full-time educator, public education, for 13 years. I am also a wife and a mom of four. Um, so I have myself is split in a lot of ways, but I became a mortgage loan originator because in my process of trying to become a homeowner, I am a first generation homeowner. I don't have parents or people that guided me or could give me information into what it takes to become a homeowner, the steps that I would need to go through, what I needed to do to qualify. I literally had to figure it out on my own. And so in that process, I would be denied and denied year after year. And I'm thinking, I'm getting my credit score up. I don't have a lot of debt. What is the issue? And no one would ever tell me what was holding me up from qualifying for a mortgage. I felt like I had the money, I was making the correct income, I had the correct credit score. And to my knowledge, that was all that I needed. And no one explained, like debt to income ratio and student loans and how those things can affect me in the home buying process. And so it held me up for a long time. And once I finally got through the process and I was able to close on a home, I knew that I needed to go back because I knew that there are other people like me. I knew there were other people who had these same questions that were not being answered, that needed answers. And so I wanted to be able to give the answer. So I went through the process to earn my license in the state of Georgia and Alabama that I can help you to become a homeowner in whatever capacity that may be. So I'm here today just to give information and answer any questions that anyone may have. Feel free at any time to chime in. You can also utilize the chat function. I will also make you aware that this is being recorded. All right. So I'm going to go through the presentation. And again, if there are any questions at any point, you may chime in. Oh. So some of the things that we will be talking about is how the process flows, what our basic qualification needs are, credit report pointers, debt to income ratio, and then the down payments and assistance programs that are available. So at the foundation is your credit. These are the basics like credit, debt to income ratio, down payment. Those are the three big things that you need in order to begin to think about qualifying for a home mortgage. You need to make sure now there are things called requirements and then there are overlays. So different lenders can require a different credit score based on their security level, right? They want to feel comfortable that you are going to be able to keep this home, maintain this mortgage, and not go into default, right? Because then they lose money in that process. So the lenders do what they feel is best to cover themselves. Um, Basic requirements is a 580. Now, are you definitely going to be able to get into a home or get approved for a mortgage with a credit score of 580? The chances are very slim. There are some situations where that can happen because it can you can have very little debt to in debt, right? And you got a 580 credit score and you have come into a large sum of money, so you have a big down payment that may be able to get you qualified. But more than likely, you're going to need at least a 620. If you can get to a 680, that's even better. So from a 620 to a 680 are the credit score requirements that will help it to create less difficulty in you qualifying for a home mortgage. The next thing that we look at is your debt to income ratio. So, and that's your DTI, and that is the big one. That is one of the things that held me up for so long that I did not understand when trying to qualify for a mortgage. So your debt is anything that shows up on your credit report. So things like your cell phone bill, your electricity bill, what else? Things like that don't generally, car insurance, things like that don't generally show up on your credit report. But the things that do are credit cards, like lines of credit. So if you have a furniture bill, if you have store credit cards, if you have a major credit card, things that you have financed, such as car payments, if you've taken out consolidation loans, if you took out a loan to have a party or pay for a wedding, things like that, that those are on your credit. Also, the big kaboom, the student loans. So student loans also show up on your credit report even if you are not in repayment. So even if you have your loans deferred or in a forbearance and you're not currently making payments on those loans, they still show up on your credit report and they can be a hindrance when trying to qualify for a loan because that still, if you took out $100,000 to get you 3 or 4 years of college, you have $100,000 worth of debt. And so that is calculated along with your current income. So that's where there are a lot of hiccups. And this is definitely a case by case scenario, depending on the lender, depending on the type of loans that you have and their current repayment status. We would have to talk about that one-on-one, but that's something that we have to keep in mind that student loans are part of your debt. And then we get to down payment. Now, down payment varies depending on the type of loan that you're trying to qualify for. So the three major loans are FHA loans, which are federal housing authority backed. Those are backed by the government, and they are kind of like a subsidy to allow more people the ability to access a mortgage. They only require a 3.5% down payment, and they only like the base requirement is that 580 credit score that I was telling you about. However, most of them require, again, at least a 620, 680, somewhere in there. There are those loans, they are very rigid in their requirements and the things that they allow. That's also something we'll go into detail about further. And if anyone has any questions, please feel free to ask. Um, and then there are conventional loans, which are the more traditional loan. You need a higher credit score to qualify for that, around a 680. There are less rigid guidelines when using a conventional loan to purchase your home. And it also typically requires only a 3% down payment. The third type that we use a lot are the USDA and veteran loans. Those are loans that don't require any down payment. They are, again, the veterans loans are backed by the government. Veterans have that option for their service to our country to purchase a home without making a down payment. And then there are also the USDA loans, which are loans for rural areas in different states, and you can purchase a home without a down payment with a USDA loan. So you go through your qualification process with all of those three. Next, you start to look for a home, right? You find a home, you find a realtor to put in an offer for on your behalf for that home. If that, I'm sorry, I skipped. Let me go back. So before you start looking for your home, you're going to get your lender to give you what is called a pre-qualification letter. That is going to not qualification, approval, right? Because we want to know that when you have this pre-approval letter and you go out to the realtor, they are going to take you a lot more seriously because they know that someone has verified you. Someone has verified that you are house ready, that you have had your credit assessed, that you have the down payments, you have the funds, you have everything in order, and you are ready to purchase, right? So that is important. When you go out to a realtor, you want your pre-approval letter with you so that they know I've been through this process and I know how much house I can afford and I'm a serious buyer, right? They need that in order to put in an offer. Um, for a home. So you got your pre-approval letter. You go out, you find a house, you let your realtor know, this is the house I found. They go to put in your offer to the seller of the home. The offer of the seller of the home is going to want to see that pre-approval letter. They're going to want to know that you're not wasting their time and you're out here putting in offers for a house that you are not qualified to purchase. So that is big also. We got to make sure, and a good, a trained, a professional mortgage loan originator is going to make sure that they have qualified you thoroughly, because you don't want to go through this entire process and then get down to the minute before closing and determine that there is some piece that's not in order, and now you've wasted everybody's time, and that's an awful thing. So me personally, I don't send out those pre-approval letters until I have checked every box and I know that you are absolutely ready to purchase this house. And however long that may take, I am with you for the long run. It could take 2 weeks, it could take 2 months, it could take 2 years. Okay, I am with you through the process. I will go back and forth and check, and we will get through to the finish line together. Um, so then, hooray, your offer letter has been accepted. The seller has said, yes, we would take this person. We're going to make the contract. We're going to schedule the closing date. We're going to get everything in order. You go to your settlement, which is at closing. But before that, underwriters have to go through and verify everything. They're going to make sure every T is crossed and every I is dotted in your paperwork and what you've said. They're going to verify thoroughly your your finances. If someone is lending you money, they have to look over those bank accounts and make sure that everything is where it should be. With that. And then once underwriting gives you that clear to close check of approval, we go to closing, and then their funds go to escrow, and you are all set with your mortgage, right? And a escrow is something else that holds your homeowner's insurance, so that that's automatically paid for you along with your mortgage, so that you don't have to worry about keeping that separate. Also, your property taxes. I will also add in that as a first-time homeowner, I did not know that property taxes could change from year to year. So that means if your property taxes change, which is something that is put into escrow and you pay it at once with your mortgage, then your mortgage could also change. So we don't have this, well, how people think that because with renting, a lot of people wanted to no longer rent because rent prices were going up. Well, it was probably going up because property taxes were going up. And so whoever owned that home was also having to pay an increased mortgage. So what happens is when you're whatever county, city you live in, if they change the amount of property taxes that each homeowner is required to pay, then that is also put into your mortgage and could make your mortgage increase. So we talked about this already, 580 credit score. These are just the basic things that I would ask you for at our first meeting and our first scheduling to see how far along in the process and how prepared you are. We're looking at your credit score. We're looking at your work history. You have to have worked 2 years at least. You have to have at least a 2-year work history in order to start the home buying process. So if you just started a job and you've only been on your job for a year, you need to wait another year before you're ready to show that you have a good and proven um, stable work history. Now, if you have worked 10 years before and you decided to take 5 years off, you're going to have to wait until you have those 2 years back in the work arena before you're able to qualify for a home. You need to have a bank account because we need to see bank statements, 2 months worth of your bank statements to see. This is something that is used just to verify how you're paying your bills, what monthly, like there may be hidden things. Some, again, with those FHA, those government-backed loans, they're very stringent and strict on the regulations. So they want to check everything. how you're getting the money. Is it cash? Does it show your direct deposits from your job? Are there other incomes that may be coming in that may be able to be used to help you qualify? All of those things are checked by your bank statement. We are not looking at your bank statement to see, what kind of other stuff you got going on, where your money is going. We are strictly making sure that when we get to closing, this is going to go through, that there's not going to be any pop-ups or things that the underwriters might come back and say, oh, well, they got a $5,000 cash deposit. Where did that money come from? Right. So we need to know all of those kind of things. We don't need those to be secrets so that we can make sure that you are going to be able to qualify. Okay, you need a valid ID and you need check stubs that show a running history. So I know some people get paid like if you're like a 1099 employee, some people just get a check written out to them. And that's fine. In those instances, we use your W-2 in order to find your actual monthly or however so often you're paid to calculate your income. But if you are a W-2, they usually have like a running history, so that is a lot easier for us to calculate your income. All right, and this is just an overview of all of the different types of loans and what the requirements are for those. If anybody wants to take like a screenshot of that, or if you have questions about those, you can let me know. We talked about the FHA loan, the veterans loan, USDA loan, conventional, and then there are jumbo loans. Those are for like if you're buying a building, right? Or something like that. All right. And these are just a few credit report pointers. The first thing, if you have credit cards, make sure that you're keeping your credit card balance under 30% utilization. You don't want to have your credit card almost maxed out. Even if you're making the payments every month on time, we still don't want to show that you got $1,000 and every month you're keeping an $800 balance on that card. That means you're using most of that card, and that shows that you're cutting it close, right? Excuse me. Two, maintain on-time payments for all of your accounts. One of the worst things you can do is get flagged for a late payment. That takes a big hit to your credit report. You can lose, 5, 10 points for having late payments, and it takes a long time to earn those points back for sustaining, on-time payments. So at every cost in the home buying process, when you are about to purchase a home, make sure that you are paying your accounts on time. 3, do not open new accounts. If you know that you're going to buy a house within the next year or 5, don't go out and purchase a new car. Okay? Um, don't do it. Don't go out and finance a wedding, right? Just don't make these big, huge purchases that you're going to put in a lot of debt, because that's going to first open as a new account on your credit. It's going to show that now you have these new debts to put on your credit report. If purchasing a home is your focus, get that done first, then go buy the car. Okay. Then take the trips and plan the wedding. But yeah, please don't. And then 4 is pay down your debt. So if you've had a car and you've had a car for 3 years and you're halfway done paying for it. The best thing to do is start to take any extra money you have, even if it's an extra 50, $100 every month, pay down your existing debt. That's going to help your debt to income ratio. That's going to help improve your credit score, which will also help you to get better interest rates. Qualify for other programs, and just overall be in a better situation when negotiating for your mortgage. Now, I know in every industry they have lots of acronyms and things that people will throw out at people and think that everyone automatically knows what they mean. So DTI is one of those things. And that stands for debt to income ratio. So, as I told you guys, the purpose of this is just to give you information and to make sure that you're informed of the process that you are going into. So, debt to income ratio shows a person's monthly debt obligations as a percentage of your gross monthly income. So, your gross income is the amount of money that you make before any taxes are taken out. So, if you make $20 an hour, you work 40 hours a week. We're doing 20 times four. That's your gross monthly income before anything is taken out for insurance, federal taxes, Medicaid, Medicare, all of the things that are taken out. We're looking at your gross. Um, and then what the qualifications for most mortgages are, we looked for under 40% is amazing, right? And when we're starting to push it, it's at that 44, 45% where it's very difficult to get you qualified. I'm not saying it's impossible, but it makes it a little harder. Here, you got to have a higher credit, you got to have more down payment, but we want to keep our debt to income ratio under 40%. So what that means is if you make $5,000, right? You don't want to spend over 40% of that as it's showing on your credit report. Okay. 50% would be $2,500. I make $5,000 and on my credit report, because of my car payment, because of my credit cards, because of my student loans, it's showing that I'm paying out $3,000 a month. That means my debt to income ratio is over 50%, which means I'm not gonna be able to qualify for a mortgage, right? So that is what I mean. We have to check our gross monthly income with the debts that we have on our credit report history. Now, this also, your debt to income ratio is also used to calculate how much house you can afford, how much you can qualify for. So what we do is we take the house, say it's a $300,000 house, and according to the your credit score and the market rates right now, we got you at a 6% interest rate. And so that means your monthly payment is going to be around $1,800, right? Can your income and your already current debts support an $1,800 addition and keep you under 40%? That's what we're looking for. That's how we know when you are able to qualify for the mortgage. So the more debt you already have, the smaller or the slim, yeah, the smaller amount of house that you're going to be able to qualify for, or a smaller amount of mortgage. All right. I talked about earlier how your debt to income limits are based on the type of mortgage that you're trying to get. And these also are dependent upon your credit score. And so conventional up to 43% is typically allowed. Again, conventional loans, you have to have a higher credit score so they can wiggle with a little, that gives a little room on the debt to income ratio. They also have less stringent rules. The FHA loan, 43% is typically allowed, 50% is possible. Now, these are very it's possible under strict circumstances, and we can talk about that later if anyone would like to email me or text me or call me later and talk about that. And then we also have the USDA loans, which are 41%, and the VA loans are 41%. Again, those two loan types are 100% financed. So even your down payment, which is not required, is also financed. The entire cost of the house is financed into the mortgage. Now, another thing that sometimes prohibits people or is a block or an obstacle in purchasing a home is the down payment and the closing cost, right? That's typically about 10% of the home price is going to be your down payment and closing cost. Mm. So there are down payment assistance programs depending on, your credit score, where you live, how much house you're trying to get. There are programs that will allow you to be given an amount, right? They give you the down payment assistance. Some of those are even forgivable. So that means you don't even have to pay the money back. Okay, there are two different types. There are forgivable down payment assistance loans and unforgivable, where you do end up paying like a small second mortgage over the life of the loan. You may, with some, you may take gifts. So if there's a family member that leaves you money or an inheritance or anything like that, they can gift the down payment or the closing costs for you. You can use your personal savings. Some people have savings accounts from their jobs, some 401ks, some retirement accounts will allow you to pull that money out in order to purchase a home. So you can check with your company and find out how it works for your company. There are also seller concessions, which means that the seller can give you a percentage of the down payment or the closing cost. Back in the day, long, long time ago, sellers would cover closing costs. Like the seller would just say, okay, we'll just, we'll pay for that just so we can get the sale and keep it going. That's when it was a buyer's market. And it was hard for people to sell their houses, so they were making it more uh making the process better for the buyer. That's not seen as often anymore. Um, and then there are lender credits. So some lenders will give you a concession for taking a certain interest rate, and they actually give you money during the closing that can go towards your closing cost or in your pocket. Okay. So it is not as difficult as it may sound. It is not impossible, but it does take intention in purchasing a home. There is planning that goes into it, and you have to be informed. And so that's what we're here for, is to answer those questions. And if you have any final questions, if there's anything that I did not cover or any questions that you may have, please feel free to contact me. I have my social media accounts as well as my email and website information. You can contact me anytime, and then once you contact me, I'll be return your message within 24 hours. Thank you all so much for joining. Thank you for your time. And again, if you have any questions, please feel free to reach out. Blessings.